Hey friends, Dan Passarelli here. Good morning to you, or afternoon, as it were, depending on what time zone you are in. I know we got people from all over the globe here, and that's pretty cool. Today, we're going to be talking about how to manage calendar spreads. Before we get started, I need to point out that options are not for everyone. Please read characteristics and risks of standardized options before trading. Get a copy of that by emailing investor services at theocc.com. Don't trade with money you're not prepared to lose. And what we're doing here is providing generalized information, not specific to your situation. Can you hear me? Type the number 9 if you can hear me. Type the number 9 if you can hear me. Larry's here. Larry's here. Awesome. Justin is here. Just in case you didn't know. David. All right. Got some of our usual suspects. I love it. Tomas is here. Excellent. Now, for those of you who are not familiar with me, I'll allow myself to introduce myself. My name is Dan Passarelli, and I am an author of a whole bunch of stuff. Golly. Two books on option trading was part of, I want to say, at least three more. Um, Fan is here. I am a fan. Uh, don't mind my Midwest accent here. And I wrote a gazillion articles and blog posts. I know most of you follow me on Substack, don't you? You follow me on Substack? Type a yes. Type the letter Y if you follow me on Substack, or N if you don't. Pandas. Excelente. Anybody else? Anybody else? You type no or the letter N if you don't. And I'm going to ask you if you're crazy because, it's free. And man, I put in a lot of time and effort into that to give you great information. And that's why you're here. David, go to here. I'm going to type this answer here. Go to wealth building with options.substack.com. I think everybody should be able to see that URL web address that I just typed in there. So go there now. Make sure I didn't fat finger it and type it wrong. And click on join. You can join for free and get that stuff. Or you can pay, I think it's like 30 bucks a month. It's less than like a fancy cup of coffee per week. And you can get the really in-depth blog post also that I write. But do that now. At least join for free. So I am an author of a bunch of stuff, and I am a trader. Been there, done that, still doing it. Every day I'm trading. And that being said, that's who you want to listen to. Somebody who still does it. Somebody who's done it professionally and still does it. And Firstrade does a good job getting some quality providers of education to you. And I am honored to be part of that stable of people that they trust to give to you. I'm the founder and still president, CEO of Market Taker Mentoring, which is the global leader in option trader education, which is kind of a cool honor. I have literally had people from other trading education outlets come and take classes from me. I could give you a list of them off the top of my head. but I'm not going to do that because I think that would be uh, compromising confidentiality. But what are these people doing coming taking classes from somebody else? Don't they already know this stuff? Didn't they have a career where they learned all these things? Because I did, and that's what I'm providing to you. And that's what I provide to our students in great depth at Market Taker Mentoring. And I am an industry collaborator. I work with all the top options friendly brokers like Firstrade, for example, and most, if not all, of the global exchange groups that are involved in option trading, software platforms. I'm sort of honored to be a go-to person for, people who need thought leadership in option trading. But enough about all that. I'm also a family man, married to my wife, Kathleen, who many of you know. She runs operations here for Market Taker, takes good care of our student traders, our two adult children, and our two cute little dogs. One of them sleeping there behind me on the couch, but it's pretty unlikely she's going to wake up during this. That dog sleeps all day unless she's eating or begging for food. And then, of course, I do other things for fun besides family and trading. I'm a runner, foodie, traveler, musician. I exercise. Oh, running's up there. Okay. So that's me. That's what I do. Now, I want to make sure that you are getting everything you can out of everything I can give you. If you listen to me and it ends up helping you become a great trader, I would be thrilled. I would be tickled pink. And so, in addition to what we do here today, I'm also inviting you to get more free stuff. Go to markettaker.com, which you can see right up here. Market as in stock market, taker as in take what is rightfully yours. That's two T's in a row. And go all the way over here to, the top right side of the screen and click on join free and join free. You get lots of complimentary classes. We'll invite you to extra complimentary online trainings like this that we do at least a couple times a month. We'll send you our newsletter once a week. We'll give you lots of great stuff. Now, let's get into the very specific matter at hand today, friends. Adjusting time spreads. I'm going to do a brief time spread review. I think we've done that before, and so I know many of you are familiar with time spreads through what I've taught you or just learning on your own. But we also have some people who are new to the Market Taker / Firstrade family, so we're going to do a brief review. And then we're going to talk about all the adjusting techniques I can cram into an hour's worth of online training. What is a time spread? Well, time spread's a calendar spread. Those are synonyms. A time spread is a horizontal spread. That is a synonym too. These things are when a trader buys one option and then sells another. That is the same type, meaning they're both calls or they're both puts. They both have the same strike. The only difference is they have two different expiration dates. So we're buying the long-term option and we're selling the short-term option. Now that is a long time spread, and that is likely to be the one that you make if you trade time spreads. It is possible to sell a time spread, a short time spread, which is the other way around, selling the longer term one, the one with more time till expiration, and buying the shorter term one. But that's a lot less common among retail traders, which is what the industry calls you, if you didn't know that. People who trade in a retail trading account. And the reason is because there's more risk to reward, I would say. And the margin that the Options Clearing Corporation requires, which is the body that governs your trading, in a sense, they guarantee your trading, and therefore they make a lot of the rules. They margin the crap out of you for short time spreads, and for good reason, because if you hold it and you let the long-term one expire, then you're just left with the, or excuse me, you leave the long option expire, which is a short-term option. Then you're left with a naked short option, and they don't like that. So we're going to talk about long time spreads. Let's take a little look-see. So there are two ways to look at option trading. We can look at the absolute risk, and we can look at the incremental risk. The absolute risk is just, here is absolutely the most we can make and absolutely the most we can lose. And our break evens, what am I talking about here? I'm talking about profits and loss at expiration diagrams. Incremental risk is between now and expiration. If a couple days pass, how much do I make in time decay? Well, we measure that with theta, don't we? If the stock goes up 77 cents, how much do I make? Well, we measure that in delta, don't we? If implied volatility changes, falls by 2 points, how much do I make or lose? Well, we measure that with vega. We're talking about the Greeks here. So as far as incremental, no, as far as absolute risk goes, when we trade a time spread, we end up with a profit and loss diagram that looks kind of sort of something like this. We have the maximum profit that occurs if the stock is at the at the shared strike price on the expiration date of the short-term option. And why is that our maximum profit? Well, because think about it. If the stock is above the strike price at expiration, what happens to those options? Well, let's start with the long-term option. Let's say it's a call calendar. Well, with the call calendar, if the stock is above the strike price at the short-term options expiration, the long-term option, the long-term call, well, that still has more time until expiration, right? So therefore, it's got a positive delta of something. And I know a lot of you folks know about the Greeks. You've attended our classes on the Greeks. So that one has a positive delta, which is above 50, but under 100 unless it's really far above the strike. But the short-term call, which is in the money and is short, that turns into, upon expiration, it gets assigned. It turns into a short 100 shares of stock. So we're short 100 shares, which is 100 delta, because the short-term call got assigned. And then we're long a long-term call that has a positive delta, but less than 100. And so the higher the stock goes, negative gamma makes us makes the delta on the long-term call closer and closer to 100, but we're still losing money as the stock goes up until that long call has 100 delta. So the higher above the strike we go, the more we lose because we have a negative delta if we're above the strike. So when it goes down, we make money until and unless the stock is below the shared strike at the short-term options expiration, in which the short-term short call expires and goes poof and disappears from your account. And the long-term call has a delta, positive delta, less than 50, but more than zero unless it's really, really low. So positive delta means the lower the stock goes, the more you lose until that call becomes a zero delta. Then you hit your maximum loss. But because it's positive delta, if it goes up, you make money. So let's see here. Let's recap. Above the strike, negative delta needs to go down. Below the strike, positive delta needs to go up. At the shared strike is the maximum profit. Very high, very low is the maximum loss. Get it? Got it? Good. All right. As far as the Greeks go, the Greeks are super important when it comes to time spreads because you know why? Here's one thing that I didn't talk about that I need to talk about. This, what's our maximum loss? The maximum loss is the time premium you pay for the calendar. That we know for sure. What's our maximum gain? I don't know. Why don't I know? Dan, aren't you an expert on this? How do you not know? Because no one knows. You can't know. Why can't you know? You can't know because when the short call expires and either becomes stock or goes poof and disappears, the long call we're left with, we can't know what that's worth because it depends on what the implied volatility is at that point. So we can't know the maximum profit, and we also can't know the break evens. With time spreads, profit and loss diagrams are just a little bit helpful. I'm not going to say they're useless because they're not. They give us sort of a loose guide to a rough break even, a rough maximum profit, but it's not going to be exact. So, geez, how do we analyze these puppies? Well, we use the Greeks. Excuse me 1 second here. All right. I muted that there so I didn't have to torture you with me coughing and clearing my throat. Delta. What's delta again? Oh, yeah, the directional sensitivity. Well, we kind of just talked about that, right? The delta can be positive or negative. It's positive if the stock is below the strike, negative if the stock is above the strike, right? Because it's got to go towards that middle. And the reason for that is, yeah, it's because of what the option expires into, stock or disappears. But that can also be described as negative gamma. Negative gamma, in the simplest terms, means your deltas move the wrong way. The more the stock moves, the more adverse, bad, your deltas get. When the stock goes higher, you get more and more negative delta. Poo-wee. If the stock goes down, you get more and more positive delta. Boo. Right? That's negative gamma. Theta. Now, here is one of the areas where the rubber hits the road. If the stock is close to the strike price, which you want it to be when it comes to time spreads, right? Remember, When the stock is close to the money, shorter term options have higher theta. So I'm buying one with a little theta, selling one with a big theta. That means I end up with positive theta and I make money as time passes. Yay! Okay. So that is guaranteed. Gosh, my throat like kind of choked up there when I said that because as we all know, nothing's guaranteed in trading, right? Well, notice I didn't say profits are guaranteed because they're not. You can lose money trading time spreads. How? From negative gamma, from the stock moving too high or too low. And that is guaranteed. So, yes, you definitely make theta every day, but you can lose that theta and more than that theta on your negative gamma. That is the inherent trade off when it comes to trading time spreads. See, look at this. Even the folks who already know how to trade time spreads, you're learning a different way to think about these. Huh? That's good, right? It's good to learn new things. But you want to learn something good and important? Vega. Vega is the most misunderstood Greek, especially when it comes to time spreads. Why? Well, because people are used to looking at the delta of a position. And they're used to looking at it and saying, oh, well, this time spread has a positive delta. No, wait, Vega. Geez, sorry about that. This time spread has a positive vega. Now, wait a minute. How do we know it's positive vega? Because the longer term options have a bigger vega than the shorter term options. They have a smaller vega. The longer term ones were buying, positive vega. The shorter term ones were selling, negative vega. Big positive plus small negative is a net positive. So a lot of people look at time spreads and they say, oh, well, positive vega. I want volatility to go up because the net vega is positive. But that, friends, is a trap, a red herring, a false positive. It's wrong. Way to think about it. What we really want with a time spread is for implied volatility to go down. Geez, that sounds weird. What is Passarelli talking about today? Is he crazy? What's going on here? Well, we have we have to look at the individual implied volatilities of each option, the short-term and the long-term one. Why? Because they move independently to one another. The long option's implied volatility will go up or down, but it just goes up or down a little bit. Short-term options, their implied volatility moves a lot more. And so the short-term options, their implied volatility is going to go up or down also, but a lot more. Because we're selling that one with negative vega, and that one moves the most, we want that one to go down, while the one we're long, if it goes down a little bit, it's okay. As long as we make more on the short option going down than the long option. It's a lot to think about when it comes to the Greeks. Time spreads are very, very underrated and very, very undereducated when it comes to trading them. Or I guess a better way to say that is that most people are undereducated when it comes to trading time spreads. They look at it as, buy this one, sell this one. We want it to be close to the strike. And hey, if it is close to the strike, you don't have to know anything. You don't have to know anymore. You don't have to be smart. It just works. But if you really want to be good at this, you got to know this stuff because it's going to guide how you put on the trade and it's going to guide how you manage the trade. So let's talk first about rolling time spreads. When I put on a time spread, I've got to do three analyses. Count them. 1, 2, 3. Technical analysis, fundamental analysis, and volatility analysis. That is how I set up a trade with edge. I want to see a stock trading in a range. I want to see a stock that doesn't have any expected volatility events like earnings coming. I do have an earnings trading calendar that I've done in a previous Firstrade video, but it's a very different way to think about it. And I have to look at the volatility. I want to sell a higher volatility in the short-term option than I'm buying in the longer-term option. Poof. I do that, and I will have gotten a good start on setting up a time spread with edge, meaning statistically sound trade, like good risk reward, likely to make money. Which expiration do I select? Well, I have done time spreads where I sell the shortest term option, which is usually what I do. But then sometimes I'll buy the very next expiration, just one expiration apart, whether that's 1 week or 1 month, depending if they have weeklies or not. Or sometimes I'll do 2 expirations apart, sometimes 3, sometimes 4, sometimes 5, sometimes 6. I prefer to do it with a couple expirations between, at least 3 expirations apart. So maybe sell the one that expires on Friday and buy the one that expires a month from now. Why? There's a reason for that. There's what I like to call method to my madness, and I'll talk about it. So once I make all these decisions, I put on the trade, and then something happened. A lot of things happen. And they're all related to delta, theta, and vega. The stock's going to move a lot or a little or barely or a ton. Time is going to pass and implied volatility is going to change. What do I do with the trade? Well, that depends on what plan I made when I made the trade. So we always want to have our plan set at the moment we make the trade. So I'm going to reassess whether I continue the trade or I close the trade. When we get close to expiration, there is when I must make that decision. So one thing I can do is I can roll the time spread. Rolling is when I close one leg of a position, in this case a time spread, and open another leg, and I do it as a single trade. One thing I can do is rolling out in time, and let's take a look at that. So let's say I put on a time spread. I did my technical, fundamental, and volatility analyses. And what do you know? This looks like a pretty statistically sound trade. Expiration rolls around, and actually the trade's working pretty good. We stayed pretty close to the strike price. Well, what do I do with this thing? I've got a short option that's about to expire and a long option that still has a fair amount of time before it expires. What do I do? Well, I have 3 choices. I can close the whole darn trade, and if we are close to the strike price, I'll take a profit. If we're farther from the strike price, I might break even. If we're really far from the strike price, I could lose money. So I could just close the whole darn thing, or I could let the short option expire and keep the long option, which I almost never do, because that would be like when I first put it on, hey, I think this stock is going to be neutral. If I let the short option expire, then it's, oh, I think the stock is going to go up. What would have changed? It's kind of weird, right? But every once in a while it does. So I leave this in here as a choice. But another thing I can do is I can roll to the next expiration. I roll the short option to the next expiration, but I keep the long option. This is why I like to have a few expirations between the two. So here's what I do. Let's say I sell one August 22nd, 55 strike call at 70. And I buy one September. Here, hold on a second. Never mind. And I buy one September 12th, 55 call. And I do that at $2.75. So I pay $2.75 for the long one, collect 70 cents for the short one. I'm paying $2.05. Okay. Let's go over to these assumptions. We're going to assume ideal trade conditions. Things are working nice. What, the stock stays right around 55. Don't you love it when that happens? Doesn't that happen all the time with all your trades? They work out perfectly and it's always profitable and there's never any stress or worry. You just put on the trade and it's like ringing the cash register, angels getting their wings, the whole shebang. Don't you love it when that happens? Yeah, it doesn't always happen that way. But when it does, oh gosh, feels so good, doesn't it? It's like making that perfect golf shot, right? Instead of ending up in the rough or the trees or the pond like my shots usually do. I love it when I get that perfect golf shot. But, you know, it doesn't happen all that often. So if it does work out perfectly and volatility remains pretty constant, implied volatility, and because these are weeklies, we have the same number of weeks in every expiration cycle. Well, or I guess that would only be for monthlies. Weeklies, doesn't matter. There's always 7 days in a week, right? They haven't changed that one on us yet. That's existed since, were there 7 days in a week before the Julian calendar, before Julius Caesar did the calendar? That's before it was redone by Pope Gregory, I forget what Gregory the what. I forget if he was the first. Anyway, I'm sure he wasn't the first. But he's the guy who came up with leap years and all that business. So yeah, anyway, for at least 2,000 years, there's been 7 days in a week, but there's not always 4 weeks in a monthly expiration cycle. Sometimes there's 5. So anyway, that last little bullet point's not relevant. So here's what I can do if we get to expiration. If the stock is pretty close to the 55 strike, then the 55 strike call will have lost money via time decay. It's not 70 cents anymore. It's maybe a nickel if we're close to the end of the day. So we can buy that short one back that we sold at 70 cents and buy it back for a nickel. And at the same time, as part of one trade, sell the August 29th, 1 week later, 55 calls at 70 cents. Now, how do I know it's 70 cents? Well, in reality, it probably won't be. It might be 68 cents, might be 79 cents. But, you know, we're just making this easy and assuming volatility remains constant. The stock basically didn't move. So if those two things are the case, it would be about 70 cents. So Okay, we buy back the one we sold and we sell the same strike 1 week later at 70 cents. So if you think about it, that roll there, that's a time spread. We're selling it. Selling the long term, buying the short term. Wait a minute, why would we sell a time spread? Well, because what do we end up with? Look at the remaining trade down here. Well, if we're buying back the August 22nd 55 calls, those go poof, they're gone, and they're replaced by the August 29 55 calls. So now we basically have the same spread on again. We sold these, we're assuming we sold them at 70 cents. It won't be exactly 70 cents. And we're long these from 275, but we're not touching them. So we still have 275 invested in it. They'll probably, I mean, not probably, they will be worth less by then if the stock didn't move and volatility remains the same because of time decay, right? So they might be trading at 250 or 240, 230, or 2 or whatever. But we have 275 invested in it still. So something interesting would have just happened if we did this. On August 29th expiration, when we sold the August 29th expiration, we would have collected 70 cents. But then if we buy, let's say those expire, in reality, we'd buy them back at a nickel. So we'd leave a nickel on the table because we'd want to have the next one on the next week. So we collect another 70 cents. Now we've collected $1.40. Collect another 70 cents. Now we've collected $1.10. Collect another 70 cents. Now we've collected $2.80. Well, we've still only paid, we haven't touched. Hold on a second. We haven't touched the long-term calls, right? We still have 275 in those. So at this point, we have now collected serially, collecting 70 cents, 70 cents, 70 cents, 70 cents, 280, more than we paid into the trade. Right? So at this point, we can't lose money on the trade. We can lose some of the profits we've made, but we can't lose money. So when we know this type of adjustment, this type of roll, we do this opportunistically. We do this when everything has gone swimmingly our way. And that happens sometimes. You get that great golf shot sometimes, but not really that often. That's why I'm going to share with you a couple other opportunities that you can use when things don't go your way, when the ball ends up in the pond. Now, one thing we're going to talk about is legging into a double calendar. What is a double calendar, first of all? Well, a calendar is a time spread, right? Synonyms. You don't even have to read any of these words. A double calendar is 2 calendars. I mean, it defines itself. A double calendar is 2 calendars. And a lot of times, that's a call calendar and a put calendar, one of each. We could do it with 2 call calendars or 2 put calendars. So what's different about the two? They're at different strike prices. So I buy one call and sell another call with the same strike but different expiration, shorter expiration. There's my call calendar. But then I also buy one put and sell a shorter term put with the same strike. And that's my put calendar. And they're 2 different strike prices. And we're talking about these only in terms of long, where we're always buying the longer term one. So let's take a little look-see-poo at that one. Now, we could, by the way, just straight away, as they say across the pond, tally-ho, straight away, sell a double calendar, or excuse me, buy a double calendar. But we're instead considering this as an adjustment to save us when the stock does what we didn't want it to do. Oh, okay. So, Dan, show me what you're talking about. Well, thank you. I'm glad you said that. Let's say we buy a 55 strike call calendar. This one, the one we've been talking about. But what if that ball ends up in the pond? Like usual. Good thing I've got 27 balls in my bag, because otherwise, I'd just have to quit because I'd run out of balls. Okay, the stock, we think it's going to stay around 55, but it doesn't. Let's say the stock falls to, say, 51. And let's say that that is through the projected break even. I'm losing a little bit of money. And if it stays here, it goes lower, it's going to get worse. Is there some damage control that I can do? Yes, there is. First thing I need to do is reevaluate. Hey, when I put this on, I thought that stock was going to stay around 55, but lo and behold, darn it, I was wrong. Went down more than I thought. Let's look for new information. Let's go through the news, see what happened. Let's look at technical levels, support and resistance. What's my new forecast? Am I expecting a retracement? Do I think there's no reason for this and it's bouncing off support? I think it's going to go back up towards 55. I mean, in that case, I do nothing. Do I think it's going to be a dead cat bounce? What's a dead cat bounce? You guys familiar with that term, dead cat bounce? That's a floor trader term. There's a lot of, just like rude and crude and crazy terms from the floor traders. Some of them, Firstrade would tell me I'm not allowed to give presentations ever again for them if I use them. Those people are animals. But dead cat bounce, that's like right on the line there, okay? A dead cat bounce is when a stock goes from here and it just goes to here and it stays there. Why do they call it a dead cat bounce? You ever throw a dead cat? That's what they do. They go, boom. They don't actually like bounce higher. They just go and stay there. Yeah. All right. Don't tell anybody I use that term. Or do you expect it to continue lower? Like we really need to do a new forecast at this point. If we think the stock probably isn't going to retrace, but it probably isn't going to go a lot lower, we think it'll stay close to here, kind of dead cat bounce-ish. Well, look, here's what we can do. We've got our original trade, sell the August 22nd, 55 calls to 70, buy the August 29th, 55 calls to 275, paid a net of 205. At this point, both of those calls are worth less. Why? Time passed, theta, stock went down, delta. Both of the calls become worth less. That's good for our short-term call, but bad for our long-term call. So we're down money. Well, what can we do? We can add another leg. We can just do a whole brand new time spread calendar. Remember, this is the 55 call calendar. Here's what we're going to do. Boop. Add a new spread to it. We're now going to not touch that first 55 call calendar. We're not even going to touch it, not even going to think about it. It's just what it is. Well, we're now going to buy the August 22nd, August 29th, 50/50 put calendar. Okay. So now we've got a double calendar on. Pair up the first two. That's the 50 put calendar. Pair up the second two. That's the 55 call calendar, the original one. We're just looking at the original prices. So what happens with this? Well, here's what happens. We go from here, right? This is our trade. Our stock price is now here. This is our original trade. But if we then add the 50 put calendar, it turns into this. It turns into like Barnum and Bailey's Big Top. There's a sag in the middle of the circus tent there. So what does this imply to us? What's the benefit here? What's going on here? Well, whenever I have a calendar, the price I want the stock to be at expiration is at the shared strike price. Well, now I've got two of these suckers on. There's two shared strike prices. The 55 call calendar, the 50 put calendar. So really, I want the stock to be at either one of those. And it doesn't really matter which one. I just want it to be at one of them. What if it's between the two? Well, I mean, right now, the stock's at 51 in this hypothetical example. If the stock is at 51, I'm sitting kind of pretty. If it retraces, I still make money. I probably won't make as much as I would have made. Usually, you know, if with the original call calendar, the max profit is here, it goes down some because we're already down money on it. And if this one works out great, this one's not going to work out great. So we don't still make the original amount, maximum profit that we would have made, but we still make money. We're going from shoot, I'm losing money to oh, I made money. And same thing if it goes down a little bit more and if it's at 50. Even if it goes down a little below 50, I'm going to make money. What if it's smack dab in the middle where the circus tent sags? Well, usually I'm going to make money on that too. It is possible for the circus tent to sag below this zero line, break even line, and for it to lose a little bit if it's in the middle. It just depends on where you can buy that 50 put calendar and how much you already lost in the 55 call calendar. But a lot of times, most of the time, the sag in the circus tent is still profitable. Hey, do we have any questions at this point before we go any further? Please hit that questions box and let me know. Inquiring minds want to know. And I have an inquiring mind. I don't think about Lobster Boy's claws or the aliens that abducted the, latest star. Not that kind of inquirer, but inquiring mind. Yeah, I got one of those. So do you have any questions? Do you have an inquiring mind? Do you have any questions? Yes, no, maybe so. Okay, good. If you have a question while I'm finishing up here, please ask it. Now, does this adjustment solve all of our problems? Well, no. What if the stock continues lower? What if it bounces back and goes way above 55? I mean, I can still lose money. It's possible. but I now have a much bigger swath of where the stock can be before I lose money. And I shifted it to the downside where the stock closer to where the stock is now. Pretty darn clever. And all I had to do was buy another trade. Now, one other thing to talk about here with this is that my maximum loss probably used to be like here. Because I just bought another time spread, if everything just goes dreadfully south, which could happen, happens sometimes. You make enough trades, you're going to see some crazy things that you thought could never happen. So you could still lose. So you do have less maximum profit and more maximum loss. So you're trading off your good risk reward for higher probability of success. Pretty good, huh? Makes sense, doesn't it? Now, there are other things that we could do. In addition to the double calendar, and this is not even in the presentation, but we've got a couple of minutes and I like giving you bonus content. Do you like getting bonus content? You like getting free stuff? You like getting free stuff? Yeah, I do. I like getting free stuff. So here's some little bonus content. What if we're at this current trade situation and we think that the stock might go back up, but maybe not for a while. Well, this is why, and I guess in this example, I put the expiration dates 1 week apart. If they're more than 1 week apart, I could theoretically roll this into a diagonal. Like say this was the, here, wait, let's go back to that one version of this trade here. Let's just look at this top one. So let's say it's sold the August 22nd, bought the August 12th 55 call. Let's say it goes down to 51 and it's bouncing off support, but it's August 22nd already, and this sucker is going to expire. Well, one thing I could do is I could say, well, I could just buy that call back for a nickel and hold the long call. I could do that. Or I could sell like maybe I could sell the 55 calls there in August 29th expiration. Or if I think it's going to go even higher, I could sell the 60 calls. So I don't know. I mean, I guess that I'm just sort of telling you all this so that you have the flexibility in your mind of being creative. That's kind of the nice thing that comes with options. Like option trade, like trading in general, is a very left brain scenario. We have to think logically. We've got to put black and white parameters on the trade itself. We think numerically, we think statistically, we think edge based. But we have a lot of choices. We have a lot of different ways to construct our trades or to reconstruct our trades into an adjustment. And so because of that, I'm a big fan of saying, what if I did this? What if I did that? What if I did this other thing? And then I just simply go and pick the best alternative. That makes sense, everyone? All good? If so, thank you for attending. And friends, I'm going to see you next week where we talk about, next week's a great one. How and when to trade straddles. That one, friends, you do not want to miss. All right. Have a great rest of your day. Trade smart, and I'll see you in a week. Bye.